So I have been investing for over 20 years now, and I have picked up a wealth of knowledge over the years on the topic of taxes. And I invest for dividends and cash flow, and I tend to believe that dividends, they are a very, very tax efficient vehicle, especially for someone like myself who is interested in living off of their investments. And so today, I want to share my knowledge with everyone out there. This is a popular subscriber question. I am so grateful I have over 7,000 subscribers here, and many of the questions that have come through over time have been about taxes. And so today I'm going to discuss my knowledge that I've picked up on taxes, not only from a dividend investing standpoint, but from a growth investing standpoint as well. I'm going to compare and contrast both of them and share some really, really exciting stuff today on the topic of taxes. So let's get ready. Certainly, I want to add an important disclaimer today that I am not a tax advisor. This is not tax advice. Taxes are very complex. I may or may not be making some mistakes even in my presentation today, and so it's important to go out and speak with a licensed tax advisor about these types of topics before making any decisions as it pertains to your taxes. So welcome to the video, everyone. Thank you so much for everyone out there who is subscribed, who is supporting. It means the world to me. And I want to answer this long-time subscriber question today about the topic of taxes. And so let's jump right into it. First, I want to start with some examples. So I'm going to illustrate what I have personally experienced on taxes through example. And example one is a recent example, actually, where I invested in a growth vehicle. Believe it or not, I am a dividend investor, and that being said, from time to time I do invest in growth vehicles, and so I am not immune from investing in growth. Anyways, I invested in Bitcoin. I invested in Bitcoin in 2017. I'll link in the description below. And I was really late to Bitcoin, but I started researching it quite heavily in 2017 after my wife had actually brought it up years and years prior, and I waited way too long to get in. But anyways, I started investing in Bitcoin 2017 around July, and my average buy price, I started averaging in between 2,000 and 3,000 per Bitcoin, and some purchases above 3,000 as well. My average price that I paid for the Bitcoin that I bought was $3,378. And I ended up selling. I'm now completely out of my Bitcoin and my other cryptocurrencies as well. As of March 2018, I actually sold most in 2017 and a little bit in 2018, whatever was left. My average sale price was $14,501. And so in a period less than 1 year, I made a 329% return. This is very abnormal. This is one of those corner cases where I saw the opportunity. I wanted to go for it. I wanted to break my mold. I usually invest for dividends and cash flow, but I saw an opportunity here to make a short-term profit and to then redeploy the profit into cash flow vehicles, my bread and butter. Anyways, this is what's considered a short-term capital gain. This is what growth investors oftentimes have to deal with. Look at this. Bitcoin now, as of today, is $7,718. So it's actually about half of the value of where I sold it from. So if I had held Bitcoin until now, and it hasn't even been 1 year. It hasn't been 1 year. Even now, it could go down further. It may or may not. It seems like it's stabilized here. But the fact of the matter is my sale price would have gotten cut in half if I waited just to try to get into long-term capital gains territory. And we'll get more into that in a minute, what that means. But the point here is with growth investing, one has to time it. One absolutely has to time it, and when it is time to get out, it is time to get out. And sometimes that will be in the short run. I never expected this to be this short of a holding period. I thought I would hold Bitcoin a few years and I would be out, but it went up way too fast, and I knew I had to get out to book those gains. And this is what growth investing is all about. Buy low, sell high. And that sell high, if it comes quickly, one has to get out. And so I got out in less than 1 year, and what happened is I was hit with a large tax bill knowingly because it's a short-term capital gain. If one holds a stock for less than a year, buys low, sells high, they are subject to what's called short-term capital gains. And short-term capital gains are basically taxed at one's marginal tax rate. And so it's taxed as ordinary income, just as one would earn from their job, from their consulting work, really from any source of income, earned income that one earns. Short-term capital gains have the same tax status. And so that is a really hefty tax bill. It is, in fact, it maxes out around 37% for the highest echelons of earners in the United States, those earning the most money. Short-term cap gains, as looked through the lens of ordinary income, it caps out around 37%. And quite frankly, there's a possible 3.8% surcharge on top of that for the high earners due to the Medicare surcharge. We'll talk about this a little bit later. And so that's just federal, by the way. If you live in a state like myself, California, there's an additional state tax as well. We'll talk about state tax versus federal tax later. But basically, short-term capital gains are big taxes. I am not a growth investor because growth investors have to buy low, sell high, and the sell high oftentimes comes within the same year. It comes within 1 year. That said, I'm really happy with this investment. I'm glad I booked those gains. And it was, look, if I can earn 329% in less than a year, I'm going to do it. And that's very, very rare. Anyways, let's go on to example number 2. This one is McDonald's. I just did a video on this. I'll link in the description below. This is a company I've owned for a while. This is really now a tale of two types of gains. So McDonald's, and this, by the way, is called capital appreciation, what I experienced with Bitcoin. Bitcoin does not pay a dividend, so there's no dividend, just capital appreciation. And that's what growth stock investors are typically after, capital appreciation, buy low, sell high. McDonald's, I actually never bought for the capital appreciation, but I did experience capital appreciation and dividend growth. So check this out. I bought this for $73.50 in 2011. As of now in 2018, it's at $159. And so my McDonald's stock, it is up quite a bit, 116%. But that is not the picture. I never bought this stock to buy low, sell high. In fact, I bought it for the dividend. And so the dividend right now, it's $4.04 per share. I divide that by my purchase price of $73.50 and I get a 5.5% yield on cost. This yield on cost will go up over time, by the way. But this 5% yield on cost it's pretty wonderful. This is 5% that I earn every year on my initial investment that comes through the door in terms of cash dividends. This is cash flow that I can literally use to pay the bills. And this is above and beyond this capital appreciation. And here is why I like dividend investing. Capital appreciation, I'm never going to sell this thing. Look, even if I did sell this thing, I'm subject now to long-term capital gains, which is different than the short-term capital gains I was talking about up here. So that's amazing. But let's say hypothetically I'd only owned this for less than a year. Let's say I made all this money, it went up 116% within 1 year of buying it. If I wanted to sell my McDonald's, I would have to pay those short-term capital gains. And certainly that's not why I invested in McDonald's. It was for the cash flow. And so anyways, by not selling, I'm deferring it. I'm just deferring it out. I don't need to sell it. I don't want to sell it. I didn't buy it for the capital appreciation. These gains are there, and one day maybe I'll make use of them, but boy, I don't need that now. And so the beauty of dividend investing is I can completely defer this side of the picture. I just don't need it. And this side of the picture, where I'm actually bringing in yield, I'm bringing in cash dividends, they are taxed at a lower rate. And so instead of paying short-term capital gains like I had to in my Bitcoin, these dividends that come in from McDonald's are called qualified dividends. Not all dividends are qualified. We'll talk about this more in a minute. But these ones are qualified, meaning they're taxed at the long-term capital gains rate. Long-term capital gains is a lower tax rate than short-term. And in fact, long-term, it's at 20% for the highest tax bracket out there. Most Americans probably fall more in the 15% capital gains tax bucket. And then there's also that potential 3.8% Medicare tax. We'll talk about that in a minute. Again, that's for the very high earners, people who have very high income coming in, but we'll talk more about that in a minute. And the beauty here is these dividends, because they're qualified, they are subject to long-term capital gains. So it's going to be a lower tax rate. And this in a nutshell is why I like dividend investing versus growth investing. Growth investing, it is so unpredictable when the gains are going to happen. Sometimes they happen within 1 year, and then I'm just hit with a huge tax bill. And the thing is let's say I wanted to be a growth investor and I wanted to live off of my growth investments. Sometimes it's just too lumpy. Like with Bitcoin, maybe I didn't need to sell so much at once. Maybe I wanted to wait a few years and sell a little bit at a time, because if I waited more than a year, it would be subject to the long-term cap gains rate. But the fact of the matter is I was like, hey, Ian, this has gone up way too fast. I need to get out of it now, immediately. And so I had to pay those short-term capital gains tax rate just because I knew I can't hold this thing over a year. But with McDonald's, different story here. I'm enjoying all this capital appreciation that I completely defer out. I don't need to sell. I'm never going to sell it. Defer it out. And the dividends, they come in quarterly. They come in predictably. They're going to grow each year over time as long as McDonald's keeps up its amazing track record. And as they grow, I'm going to have more and more cash flow that I can use to pay my bills. And this cash flow that comes in, it's going to be taxed at a lower rate. Here's another way of looking at it. Let's say I want to, someone just did a comment about this. This is interesting. I was doing a video about, actually my last video about growth stocks versus dividend stocks. And the person had asked, hey, Ian, why not just earn enough money to pay your bills? And then you don't have to worry about growth stock versus dividend stock. You don't have to worry about cash flow. But at the end of the day, why does one invest? One has to have a greater goal. Maybe the goal is to have a lot of money to give to charity. One of the goals maybe is to live off of the cash flow like me. But there's no real sense in investing and accumulating money if there's no goal. There's no goal in the end. And so when one looks at it through a practical lens, like, hey, I'm investing for a reason. I'm investing to pay my bills. One can do that, and they can invest, and they can have cash flow coming through, or one can have a job. They can go out and earn income. When one earns income through a job, it's going to be it's taxed as ordinary income, which is at the higher tax rate. Dividends, though, dividend income, it's always, as a qualified dividend at least, taxed as long-term capital gains. And so this is why dividend investing, in my opinion, is so effective and so efficient, is that it is taxed at a lower rate than people who are out there working and earning a paycheck. This is key. If I were to go out and earn a paycheck, that income that's coming through is taxed at a higher rate than if I have passive income coming in through dividends. So not only is living off of dividends amazing and it frees up my time, it gives me flexibility, but I'm rewarded. I am taxed at a lower rate for having my income come in passively versus actively, which I think is amazing. And so, in my opinion, dividend investing is very tax efficient as compared to earning income, and it's very efficient oftentimes as compared to capital gains, short-term capital gains, growth style investing, because it's subject to long-term capital gains in many cases for qualified dividends at least. So, these are the first two examples. Now I just want to go into some notes. I want to get into the nuts and bolts of what I've picked up as it pertains to taxes over the years. And so stick with me here. I know this tax stuff gets complex, but it's very fundamental, very important to understand this as a dividend or growth or any kind of investor. So also worth noting, taxes are paid on a federal and state level. And so I live in California, and so I'm subject to federal taxes, but I'm also subject to California state taxes. And when one is an investor, it's really important to research the state taxes because they're very different state by state. So in California, for example, they don't even distinguish the difference between short-term and long-term capital gains. In the highest tax bracket, it comes in at 13.3%. And whether you have a dividend coming in, whether you have a capital gain coming in, a short-term capital gain, like in my Bitcoin example, it's all at that same marginal rate. And 13.3 is the highest marginal rate right now of them all for California. But there are other states, for example, like Texas, where there is no state income tax on income. And so Dividend investors who are earning dividends, or capital gains investors, growth investors who are earning capital gains, they're not going to be subject to any state tax, to the best of my knowledge, on those investments if they live in Texas. And so the key here is to sit down with a qualified tax advisor to understand your state, understand the implications of your state, and quite frankly, to start thinking about the bigger picture too. If maybe you live in a state that's less advantageous for taxes, maybe at some point in your future, maybe when you have enough dividends to live off of, would it make sense to consider living in other states? It might not, or it might, but it's certainly something to think through, because the state income tax can be wildly different for investments and for earned income state by state. So next note, there is, again, just to summarize, short-term capital gains is the same as ordinary income, earned income. It maxes out at 37% on the federal level. And I want to talk about this now. There's this 3.8% Medicare supplemental tax. This really started popping up in recent years. This is for people who earn more money, higher amount of money. So certainly talk to your tax advisor about it to see if this affects you. But certain people are going to be subject on any dollar amount. I forget what the threshold is, but all dollars above a certain threshold, they're going to get this extra 3.8% tax above and beyond the 37 that already exists. And my understanding is the reason for this 3.8% is really the advent of Obamacare. Now that there's the Affordable Care Act, now that there is Obamacare, this 3.8% tax has surfaced. And so it's certainly something for everyone to keep an eye out for. However, this tax actually affects both short-term capital gains and long-term. So short-term really applies to two types of investments. Short-term capital gains apply to investments where one buys low, sells high, like my Bitcoin, and they do it in less than a year. Or it also applies to dividends that are not qualified. These are dividends that typically come in from a real estate investment trust, for example. Because a real estate investment trust, it avoids double taxation. There's no taxation paid at the corporate level. It's passed down to the shareholder level. The shareholders are paying the taxes at that short-term capital gains ordinary income rate. And so that's something else important to know about ordinary income. Moving down, long-term capital gains. Long-term capital gains, if one is a growth investor, let's say I held my Bitcoin for more than a year, then they fall into the long-term cap gains bucket. Also, long-term capital gains affect people who invest in dividends, because qualified dividends are treated as long-term cap gains. And again, to summarize, long-term cap gains max out at 20%, but also that 3.8% Medicare surcharge can pop up in that bucket as well for people earning a lot of money. And so certainly discuss that with your tax advisor as well. So moving down, we talk about qualified versus non-qualified. Most of the dividends that I have generated in my dividend portfolio are qualified dividends. I don't have huge exposure to real estate investment trusts, although I own one of them, and I've discussed this in prior videos. I'll link in the description below. And there's a reason for that. Part of the magic of the tax-efficient structure, of the tax-efficient strategy of investing in dividends, is to achieve this long-term capital gains rate, to achieve this qualified dividend rate. And so I try to stick towards companies that pay qualified dividends because, again, I believe it's a tax-effective vehicle because my tax rate on my dollars coming in, my passive income coming from dividends, is lower than if I were to go out and earn the same income, but it's only going to be that way if I stick towards those qualified dividends. And so certainly something I always have top of mind. What else? Okay, I get a lot of questions here about tax advantage accounts versus non-tax advantage accounts. And people ask, hey Ian, do you invest most of your money in your retirement accounts or your individual accounts? How do you mix it up? Personally, the reason I invest in dividend stocks is to have the opportunity to tap into my stream of income at any time. If I wanted tomorrow to start paying bills with dividends, I could do that. And I take this seriously, and for that reason I tend to skew towards those individual accounts that are just not tax advantaged, just normal accounts with a broker that are not tax advantage. Although everyone knows there's these tax advantage accounts out there like the 401k, like the Roth IRA. And I want to talk about those for a minute. So with the Roth IRA or Roth style accounts, I love these accounts. If one is going to look at a tax advantaged account, the beauty of those types of accounts is one pays taxes on all the money that is going to go into those accounts before it ever goes in. So one earns money, pays taxes on it, then they put it in the Roth account. At that time, the money can grow over time in the Roth account, both through capital gains, through trading, through dividends, through interest on bonds, on whatever kind of investment one wants to hold. There's no further tax paid. And then when one withdraws it at retirement age, they can just go and use that money. I love that. And I think that's a wonderful strategy for someone who, unlike me, may be willing to wait until they're of retirement age to start tapping into their funds. In my case, however, like I said, I don't want to wait that long. I just want to be able to tap into my money immediately. And for that reason, I tend to skew towards non-retirement accounts. But anyways, those are Roth accounts, and it's worth mentioning here because if one is looking at a long-term playbook and one doesn't want to retire early, one doesn't want to live off of cash flow early, whether one has a dividend strategy or growth stock strategy, one can participate in this Roth account and minimize taxes big time. And I'll tell you why I like Roth accounts through counterexample. Okay, 401k. Many big employers offer a 401k. These are really cool because oftentimes employers offer a match and it's free money because they'll dollar for dollar match up to a certain limit. I love that. And I think that oftentimes 401ks are great at minimizing taxes in the short run because pre-tax money goes in there. Basically, money that one earns, it just goes into the 401k, and that's before paying taxes on it. Someone doesn't have to pay taxes at the time it goes in. And so one has more money working for them in the short run, compounding, all tax-free, compounding. But when retirement age comes and one has to withdraw money from the 401k, that's when one is going to pay taxes. And here's the deal. Let's say your retirement is 20 or 30 years out. Let's, by raise of hands here or comments below, do you think taxes are going to be higher in 20 or 30 years or lower? Personally, and this is, by the way, I'm not going to take credit for this. This is something one of my my CPA friends, tax professionals, brought up that I just think is really eye-opening. Is the problem with the 401k is if one looks at the future of our country, and look, the Medicare, there's already this 3.8% surcharge on it to pay for Obamacare. But the fact of the matter is that's not enough. If one looks at the amount of money that's going to be paid out from Medicare over the next 20, 30 years, I once heard a statistic that I was actually at a health insurance conference. This is a statistic I heard. That amount of money that's going to be paid out by Medicare is going to be more than the tax revenue that has been generated in the entire history of the United States. And so taxes, in my opinion, are probably going to go up over time. And so the downside of a 401k is money can go in pre-tax, it can minimize short-term taxes, and it's a cool thing because of the employer match and because the money can grow tax-free. But the two cons are if one needs their money now, like me, wants the opportunity to live off of dividends or their investments now, certainly one would have to wait until retirement age. So that's con number one. Same con that existed, by the way, with a Roth account. But the con with the 401k that does not exist with Roth is, yeah, the pre-tax money goes in, but when it's time to withdraw, boy, it's quite likely that the tax rates at that point are going to be higher. And they could be very high. And so the way I look at my personal playbook, at least, is that scares me a bit. And so just something worth noting. What else? International. So this video would not be complete, my tax video, without talking about international companies as well. So I get a lot of questions here. Hey, Ian, do you invest in international companies? Yes, I do, and I have recently described one of them in one of my recent videos. It was a UK-based stock that is traded as an ADR, American Depository Receipt. on the US stock exchanges. And what's great about UK-based stocks is the UK, US have great relationship and a tax treaty. And so when dividends are paid internationally on a UK-based firm, such as the one I own, there's no foreign withholding. Let's contrast that. So if one owns a stock based out of the US, owns a stock in Canada, for example, and I own one of these actually. Again, it's an ADR. It's traded on the US stock exchange as an ADR. But because it's a Canadian company, and the US actually, they do have some kind of treaty with Canada, but not as favorable as with the UK, I have what's called a foreign tax withholding. So on my dividends that I earn from my Canadian company, they are, at time of payment of the dividend, a portion of it is withheld from Canada, from the Canadian government. And it's what's withheld? I think it's roughly 25%. I'm not positive on this number, by the way. Actually, I didn't take time to look back at my taxes for this, but this is something I picked up on the internet. But another number was saying 15. But basically, there's that foreign tax withholding, and you don't have to worry about what the number is. It's automatically going to be withheld. The good thing, though, about this is at the time that one completes their tax return, there's what's called a foreign tax credit. So this 25% of my dividend income that was withheld, I can claim it back as a tax credit on my tax return. And so basically I get the money back, but it only comes back at time of taxes. And so if one invests in a lot of international companies, it's going to be important to understand what the withholding rates are by country, and to take great records and to keep good records so that when tax time does come back, to make sure to take advantage of that foreign tax credits that one can claim on their taxes. So what else? Before I leave today, I want to talk about one last concept I picked up over the years on taxes. And this is one that applies to dividend stocks, growth stocks, any type of investment. There's what's known as a capital loss. So if you buy, let's say Bitcoin, this happened in reverse. Let's say I bought like sometime early 2018 when it was, or late 2017 when it was at its peak, and now I'm selling at 7,000, so I lose half or more of my money. It happens. People out there lose money. I've lost money on stocks before. If you buy high and sell low, you're going to lose money, and that's called a loss. And so there's two types of losses. There's a short-term loss and a long-term loss. What happens is if someone loses money, basically the tax code will allow on a year-by-year basis to take up to $3,000 of those losses and use them against gains if one is booking gains by buying low and selling high. And if one doesn't use all their losses, they can carry over into future years. And so this does not affect me as much just because I don't buy low, sell high. Bitcoin was a complete anomaly. I do it from time to time if there's an opportunity to earn something like 300+% in a short amount of time. It's rare that I'll do it, but it's worth noting just because I want this video to be comprehensive for people who invest in growth stocks, dividend stocks. If one buys low, sells high, and books gains, one can cross out some of those gains by taking losses against them as well. If one has losses that are carrying forward from prior years or even from the current year. And the way it works is one will have a bucket on their taxes of short-term losses and long-term losses. And you'll use short-term losses against short-term gains, long-term losses against long-term gains. But once you've wiped them all out, let's say you have some long-term gains, you've wiped out all your long-term losses, but you still have some short-term losses. My understanding is they'll let you use the short-term losses against the long-term gains at that point to wipe some of them out and to reduce the tax bill. So, boy, more complex video here than you guys are probably used to, but I hope you enjoyed it. I know this comes by popular request. There's a lot in here. I think it's important to understand all of this. Certainly, I want to add an important disclaimer today that I am not a tax advisor. This is not tax advice. Taxes are very complex. I may or may not be making some mistakes even in my presentation today, and so it's important to go out and speak with a licensed tax advisor about these types of topics before making any decisions as it pertains to your taxes. So before I leave today, I just want to add a full disclosure. I am long. I own McDonald's company in my portfolio, ticker symbol MCD. I own that one. And also just a disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. This is not tax advice. I'm not licensed tax advisor. This is just for your fun and entertainment. And before you go out and invest money in the stock market, please consult a licensed financial advisor. Before you go out and do anything with your taxes, please consult a licensed tax advisor first. I want to take this opportunity to really thank you. I thank everyone out there for the support. If you enjoyed the video today, I would love to hear what you think. Please put it in the comments below. What do you think? Do you like growth stocks, dividend stocks? Do you think dividend stocks are tax efficient like me? It seems like most people out there, when I say that I think they're tax efficient, they completely disagree. So I'd love to hear what you think. And let's keep this community strong, and let's keep the great debates and conversations going on in the comments. It's really fun to watch them, to participate in them, and it means the world to me. I will see you in the next dividend investing video.